If you want to save a ton of money, make your coffee at home, eat rice and beans, and ride a bike to work.
You gotta be kidding me.
Yes, I'm kidding you. This video isn't about giving up the little $3 coffees or canceling your Netflix. This video is about the 9 big money-saving hacks that can save you hundreds of thousands of dollars in your lifetime. So if you want to reduce unnecessary spending and not change your quality of life, make sure you watch this video till the end. Number 1, car hacking. One of the biggest reasons most people can't build wealth is because of transportation costs. It's usually someone's second biggest purchase in their lifetime and one of the biggest depreciating assets. Driving is expensive. You need to pay for gas, maintenance, repairs, insurance, tickets, and if you're like most people, you finance a car through a loan. After interest, fees, and taxes, the average cost of a new car in Canada is $64,000. Let's say you drive 25,000 kilometers a year. If you're lucky, you might get 12 years out of it. So with just your car payment, you're spending $5,333 a year. Do this for 25 years and you spend over $130,000. The alternative? Car hacking. This is when you buy a used car with cash that's already been depreciated. Start low. Think like a $3,000 car. If you can get 3 years out of this, that's $1,000 a year. If you could repeat this for 25 years, you only spend $25,000. Now you will have more repair fees, but it won't be anywhere close to $130,000. But what if you want to drive something nicer? In order to do that, you'll need more money. Since you have no monthly payment, put $500 away each month for the next car. After 1 year, you'll have $6,000 plus a car that could sell for $2,000. Buy your $8,000 car and repeat the process. After 5 years and delaying gratification, you could be driving a car worth $28,000. Just consider that the higher you go, the more depreciation you will have, so the higher yearly cost will be. So to save the most here, buy fully depreciated vehicles. Number 2, house hacking. Your housing cost is likely your biggest expense, well, after taxes. For renters, you have utilities, renter's insurance, and the cost of rent. For homeowners, you also have utilities as well as home insurance, property taxes, maintenance and repairs, mortgage and interest, and possibly condo fees. This is where house hacking comes in. House hacking is simply renting out a portion of your house. This could be anything from a room to the basement or even just a parking space. If you're able to rent out a room for $500 a month, this will net you $6,000 a year. That ain't chump change. In 25 years, that's $150,000. Now you may not want to do this for 25 years, but you could. If you're not willing to do this, consider the cost of rent or mortgage. Is having that extra room or basement costing you an extra $500 to your monthly payment? It might make more sense to downsize. All extra space does is cause a void that needs to be filled. So you buy more stuff because you have the room for it. If paying less for a house can save you $350 a month, you can still save yourself over $100,000 in a lifetime. Number 3, low cost investing. If you contributed $10,000 a year for 25 years and earned an 8% annual return, you could have almost $790,000 minus your investing fee. With a mutual fund, you may see a 2% annual fee, which will leave you around $581,000. With a managed portfolio like Wealthsimple, which only charges 0.52%, you'll be left with around $728,000. So just by using a managed portfolio over a mutual fund, you can save $147,000 in 25 years. If you want to save an additional $36,000, manage it yourself and just buy an all-in-one ETF. Just make sure you use a platform with no commission fees like Wealthsimple. If you're interested in investing with Wealthsimple, use my link in the video description below to earn yourself a $50 bonus when you invest at least $150. Number 4, accelerated mortgage payments. The most common way to pay a mortgage is with a 25-year amortization period and a monthly payment. The problem is that this method will cost you the most in interest. Let's look at a $500,000 mortgage with a 5% interest rate, a 25-year amortization period, and a monthly payment. In 25 years, you'll pay around $372,000 in interest. Now, if you instead opt for the accelerated weekly payments, you'll pay around $311,000 in interest. That's around 60 grand in the difference, and it only takes you 21 years and 7 months to pay off the mortgage in full. This is because an accelerated weekly payment is your monthly payment divided by 4. This assumes that there's only 4 weeks in a month, but 4 weeks a month is only 48 weeks, when we know there are actually 52 weeks in a year. So 4 extra weekly payments is equal to 1 extra monthly payment a year, and that equals to money saved in the end. Now, there are many other ways you can save on interest, like making lump sum payments, increasing monthly payments, and lowering amortization periods. Just check with your lender to see your options in your mortgage contract. Number 5, automate your savings. Most banks and financial institutions will allow you to automate your savings. This is simply setting up a transfer from one account to another. Go to your transfers section in your banking app and set up an amount you wish to transfer from the account that receives your paycheck to a savings account, whether at that financial institution or a different one. Then set how often, usually weekly, bi-weekly, or monthly. This way, every time you get paid, money will automatically transfer to your savings account. This is known as paying yourself first. The amount you transfer will depend on your budget and how much discretionary income you have. Let's say you can save $500 a month. After 25 years, you'll have $150,000. That's without interest. If you keep it in a savings account at a big bank, the interest earned won't even keep up with inflation. But if you shop around with online-only banks, you may see rates that are at par with inflation. But if you really want to grow these savings, you'll need to automatically transfer it to an investment account where you can automatically invest your $500 a month, which can be $475,000 in 25 years with an average interest rate of 8%. So by automating your savings and automating your investing, you can save and grow $500,000 with very little effort. Number 6, transferring credit card debt. The average credit card interest rate in Canada is around 20%. This means if you had a credit card balance of $10,000 and only made the minimum payment, you could pay almost 10 grand in interest and would take you almost 11 years to pay it. Now, if you have the money, just pay off your credit cards and minimize the interest you pay. But if you don't have the money, you still have a few options here. The first one you'll want to try is transferring to another credit card with a promotional 0% interest for usually a maximum of 12 months. This will likely include a transfer fee of 1 to 3%. Theoretically, you can keep transferring to a new promotion till your balance is paid off, minimizing the interest you pay. Once you exhaust this method, transfer to a line of credit. Line of credits, especially secured line of credits, will have a much lower interest rate than credit cards. So shop around and find the best rates available. And if for some reason you can't use a line of credit, other options would be transferring to a low interest rate credit card or taking out a personal loan and using that to pay off the credit card debt. And if the debt is unmanageable, consider a consumer proposal or bankruptcy. Number 7, registered accounts. How can registered accounts save you money? One word: taxes. Any interest, dividend income, or capital gains is subject to tax. But if your assets are in the appropriate registered account, you can save thousands of dollars in taxes. An RRSP account can defer your taxes, and when you do pay taxes on it, it will be at a much lower tax rate. The TFSA will protect all assets inside from the tax man. So if you had $100,000 in a TFSA and it grew to $500,000, when you go to withdraw, no taxes will be due. Other registered accounts include the RESP and the FHSA. The registered account you need will depend on your goals and your personal situation. Number 8, lower interest rates. Your credit score and other financial factors will affect the interest rate you get from personal and auto loans or a mortgage, and may even affect your credit card interests. Imagine getting a mortgage rate that's 0.5% higher just because you have a less desirable credit score. After a 25-year mortgage, the difference between a 5% interest rate and a 5.5% is $61,122. These interest rates get even bigger when dealing with car loans. With an excellent credit score, you can get an auto loan right now for around 7%. With a bad credit score, you can see an interest rate of 20% or higher.
I'm fainting. I'm going to faint.
The fix here is to improve your credit score as much as possible. You can do that by watching this video up here, or looking for the link in the video description below. Number 9, paying less taxes. Taxes are likely the biggest expense you will have. So why pay more than you have to? The government isn't going to tell you that you missed a bunch of deductions and tax credits you can qualify for. Even your tax preparer may not know everything about your situation unless they ask or you tell them. So the best thing for you to do is to familiarize yourself with all deductions and credits on the federal level and also the provincial level. This may be time consuming, but it can save you thousands of dollars. And once you know it, it's not hard to stay updated. You may also want to talk to a financial advisor to see the different tax strategies that work for your situation. The most significant way to save on taxes is to start a business. As a business owner, whether you're a sole proprietor or a corporation, there are many more deductions, credits, and strategies you can use to your advantage. If you want to learn more about reducing your tax bill, check out this video up here or look for the link in the video description below. In your lifetime, you're only going to make a set amount of money, so you can only spend so much. But if you follow these tips, you'll reduce a big chunk of unnecessary spending and have more money to spend on the things you actually want. Now, if you want to save even more money, you'll need to keep educating yourself. You can do that by watching one of the videos on the screen. Thanks for watching. Keep making money moves.